Hello, friends. If you trade the markets, there's one setup that's probably every trader's favorite, and that's the breakout trading setup. But here's the truth. While many traders make money from breakouts, even more lose money because of them. Why? Because they can spot a breakout, but they don't know whether it's a real breakout or a fake one. So, in today's video, we're going to break down the breakout strategy step by step. By the end of this video, you won't just take trades because you see a breakout. You'll understand the market psychology behind it. We'll cover what a breakout is, the different types of breakouts, what fake breakouts are and how to avoid them, and finally, how to use breakouts to find high probability trading opportunities. So without wasting any time, let's get started. First, let's understand what a breakout actually is. In simple terms, a breakout happens when price breaks through an important level and starts creating new momentum in that direction. The market never moves in a straight line. Sometimes it trends and sometimes it moves sideways. When price breaks an important barrier and either buyers or sellers take control, that's what we call a breakout. But not every level break is a real breakout. If price only pushes above a level with a wick and then quickly comes back, that's not a breakout. A real breakout happens when buyers or sellers genuinely take control of the market. Now, how do we know whether a breakout is real or fake? We'll cover that in just a moment, but first let's look at the different types of breakouts. Generally, breakouts can be divided into three categories. The first one is the range breakout. Sometimes the market moves within a tight range for a long period. This is known as consolidation or a sideways market. When price finally breaks out of that range, it's called a range breakout. These breakouts often lead to strong and fast price movements. When the resistance is broken, buyers become aggressive and push the market higher. Similarly, if support is broken, sellers take control and the market can move sharply lower. The second type is the horizontal breakout. This is one of the most common breakout patterns. Here, price moves between a clearly defined support and resistance level for some time. When it breaks above the resistance or below the support with strong momentum and closes outside that range, it's called a horizontal breakout. This setup works well, although the move is often not as explosive as a breakout from a long period of consolidation. The third type is the trendline breakout. This is one of the favorite setups among experienced traders. For example, if the market is making lower highs, we draw a bearish trend line. When price breaks above that trend line, it may signal a buying opportunity. Likewise, if an uptrend trend line breaks to the downside, it can signal a selling opportunity. With the right confirmation, trendline breakouts can lead to very powerful moves. Now let's talk about fake breakouts and how to avoid them. A fake breakout is one of the biggest traps in the market. Price breaks an important level, everyone thinks the breakout has happened, retail traders jump into the trade, and just a few candles later, the market reverses in the opposite direction, hitting their stop losses. This happens again and again. As a result, many beginners start blaming breakout trading itself, when in reality the problem isn't the breakout, it's the entry. That's why confirmation is so important before taking any trade. It not only helps you find high probability setups, but also protects you from fake breakouts. Before entering any breakout trade, always use these three confirmations as your filters. The first confirmation is a strong breakout candle. If the breakout candle has a large body, shows clear momentum, and closes strongly beyond the support or resistance level, the chances of a successful breakout increase significantly. A wick alone doesn't confirm a breakout. Very often, price briefly moves above or below a level, creates a wick, and then returns back inside the range. That's a fake breakout. So always wait for the candle to close. A strong close outside the level shows that buyers or sellers are actually in control, making the breakout much more reliable. The second confirmation is volume. A breakout becomes much stronger when it's supported by increasing volume. High volume tells us that buyers or sellers are actively participating in the move, giving the breakout real strength. If price breaks a level but volume remains low, there's a much higher chance that the breakout will fail because there isn't enough market participation to support the move. That's why you should always check volume along with the breakout candle. A strong candle combined with high volume creates a much more reliable setup. The third confirmation is the retest. This is one of the favorite confirmations used by professional traders. After a breakout, the market doesn't always continue moving immediately. Very often, price comes back to retest the level it has just broken. If that previous resistance now acts as support, or previous support becomes resistance, and price starts moving back in the breakout direction, the retest is considered successful. Taking your entry on the retest is generally much safer because it reduces the risk of getting caught in a fake breakout. It also allows you to place a tighter stop loss, which improves your risk-to-reward ratio. So instead of chasing the breakout candle, it's better to patiently wait for the retest. Now let's understand all three confirmations with a practical example. Let's say we're looking at the 15-minute chart of XAU/USD. The market is in a downtrend, and we've drawn a bearish trend line. For quite some time, price has been respecting that trend line. Suddenly, a strong bullish candle breaks above the trend line with solid momentum. The candle has a large body, and it closes clearly above the trend line. That's our first confirmation, a strong breakout candle. Next, we check the volume. We notice that volume during the breakout is much higher than normal. This tells us that buyers have entered the market aggressively, and the breakout is supported by real buying pressure. That's our second confirmation, high volume. Even now, we don't enter the trade immediately. Instead, we patiently wait for the retest. A short while later, price comes back to the broken trend line. This time, instead of acting as resistance, the trend line acts as support. At the same level, a bullish candlestick pattern forms. That's our third confirmation, a successful retest. Now we have all three confirmations together: a strong breakout candle, high volume, and a successful retest. This is where we can consider taking a buy trade. Our stop loss goes below the recent swing low formed during the retest. As you can see, price then continues moving strongly in our direction. For the target, we can either aim for the next major resistance level or simply follow our trading plan using a minimum 1-to-2 or 1-to-3 risk-to-reward ratio. This is exactly how professional traders approach breakout trading. They don't enter just because a level has been broken. They wait patiently for confirmation. That's why they get trapped in fewer fake breakouts, and the overall quality of their trades improves significantly. So remember, don't enter a trade the moment you see a line being broken. Always use these three confirmations as your filters. When all three come together, the probability of a successful trade increases dramatically, and avoiding fake breakouts becomes much easier. If you found today's video helpful and learned something new, don't forget to hit the like button and share this video with your fellow traders. And if you want to learn trading step by step with practical explanations, make sure to subscribe to the channel and turn on the notification bell so you never miss an educational video. I'll see you in the next video with another powerful trading concept. Thanks for watching.